Well, hi, everybody. This is our Crexi Pro perspective. Thanks, everybody, for joining us. We're pretty fired up today. We have a couple of good friends of Crexi joining us from Las Vegas today from Logic Commercial. We have Adam, Malan, and Deana, Marcello, who are very active in the market, both been longtime residents of Las Vegas. They represent a bunch of big institutional type clients and including some major national tenants, very active in the market there. So we're pretty excited to hear what they have to say about the Las Vegas market. I think a lot of us are looking at Las Vegas with this whole COVID thing just to kind of see how it all goes and when they all open up and when things sort of start getting back to normal, trade shows and conferences and things. And it's such a diverse place with all the hospitality and gaming, as well as, all the other things that go on in Las Vegas and all those different submarkets. So it's a little different than most of the major metropolitan areas. And that's why I think a lot of people look at Las Vegas and go, when are they going to be back? And so we're really excited about getting some feedback from Adam and Deana today. So, and also I should have introduced myself too. I'm the host, Bob Drury. I run the transaction platforms at Crexi, and my associate, Robert Anderson, is the co-host today. He's going to be helping me with some of the questions and stuff as they come in. And I would encourage anybody that's listening, if you do have any questions that come up, just feel free to pop those in the chat, and we'll get to them as quickly as we can. So anyway, welcome everybody. Maybe Adam and Deana, you might just 2 minutes real quick, just give everybody a little bit of your background and really what you guys are focused on there in Las Vegas and how long you've been doing this, that sort of thing.
Sure, and thank you so much for having us. We're excited to do this with everybody and give you a better overlook on Las Vegas and the retail market. Adam and I have been working together for the past 9+ years here at Logic. Logic is a full service commercial brokerage. We have property management, asset management, capital markets, and we service all of Nevada. So we have an office in Reno, and then we also have an office here in Las Vegas where Adam and I are based out of. We've been working together for the past 9 years, started at another firm. Adam's a founding member of Logic, and we did about $320 million between last year's 2019's transaction and thus far in 2020. We really focus on retail sales and retail leasing, and we do work with a lot of institutional landlords, clients, and tenants that we represent as well.
Yeah, so it sounds like you're crushing it there. That's what I just heard, right?
Doing our best, trying our best.
Yeah.
The markets remain busy. It was a real charging market in 2019, and it was blowing the doors off into the start of 2020. And it seems like even throughout this pandemic and downturn, there's been a lot of work to do.
Well, so that probably just goes on. So current state of the market there, I mean, pre-COVID, post-COVID, demand. What are you guys seeing?
Top line, we're at about a 70% decline if you take the visitor volume in June of 2019 and compare it to June of 2020. 3.6 million visitors in June of 19 and 1.1 million visitors in June of 20. Year to date is not quite that far off. Year to date through 2019 would have been about 21 million visitors. And year to date thus far in 20 is about 9.7. So about a 55% decline. But clearly, weekday business is, you touched on it earlier with conventions and business travel is really what's hurting Las Vegas and hurting the economy right now. The weekends aren't what they used to be, but the weekends are generally busy and, keeping things afloat. But, you really pay the bills Monday through Friday here.
Right.
And without convention traffic, without business traffic, it'll be tough to get fully recovered in terms of our unemployment and stabilization in the tourism and hospitality.
But and you guys focus primarily on the retail segment there, single tenant, triple net sort of stuff. How are you seeing your sort of overall transaction volume? Is it is it similar to last year? Because I think that there's still pretty big demand and there's a lot of capital out there that people investing in Las Vegas. So I was just curious if you've seen, sort of any trends in your business that kind of show that market's slowing down. I'm not really seeing it necessarily. We actually closed a deal yesterday in Las Vegas, a land deal that we helped the county sell 6 months ago. So, home builder closed it. So the housing market looks good. So I'd be curious what your take is just on your pipeline and your transaction volume.
Yeah, I mean, I would say that transaction volume has certainly dropped off compared to how strong it was last year, but there are still plenty of transactions happening. When Deana and I take an asset to market these days, I'd argue it's 25 to 50% of the total activity that you might have expected, pre-COVID or 2019. But of that activity, I think buyers that are out looking for deals right now are looking to transact. And there's been enough 1031 exchange back and forth in terms of just swaying the market. First the extension and now maybe the threat of it going away, that we've seen transaction volume hold together probably better than most people thought. In terms of pricing, real flight to quality, newer construction, upper end demographics, quality corporate tenants. Really haven't seen much more than a 25 basis point shift in cap rates. But big disparity between that and franchise driven concepts, et cetera, in terms of demand.
And I think buyers are focusing on, essential businesses. For example, we have a Albertsons single tenant net lease on market right now, and we have about 5 offers on that. And so I think they feel comfortable still transacting in that type of retail where it wasn't shut down. Grocery sales have skyrocketed and done some of the highest volume that they've done historically. And so I think buyers are very comfortable with still transacting on essential business. Also, I think buyers are focusing on, if they're looking at single tenant net lease and maybe in the restaurants, they are looking for drive-through type tenants. They're focusing on tenants that can survive if there was another shutdown or more restriction where they can still practice social distancing and such. And so with our drive-through single tenant net lease assets, we seeing very strong activity. So I think, about a 25 basis point difference, but I think buyers are still very much engaged.
And kind of to your point too, Gary, I mean, there is a plethora of capital out there looking to chase distress that haven't really seen manifest itself yet. Whether it's the level of stimulus out there and PPP and what have you, but we haven't really seen the disconnect in pricing or defaults yet. But I can't tell you how many calls we get daily with groups out there that have war-chested, investment dollars to go after discounts that they hope are coming.
Well, so are you seeing most of your buyers coming from someplace else other than, are they Western U.S. or are you getting buyers from all over the place?
I'd say we're still, largely, a submarket of Southern California, if you will. We get a lot of buyer activity from the California market. That continues to increase, as legislation and different, bills get proposed out in California. It just seems like that the environment there in terms of real estate has really been one of the big drivers for investment here in Las Vegas. So certainly we get buyer pools from all over the country and all over the world traditionally, but pre-recession, pre-COVID, now you really have maybe a 50% plus or minus out of California.
Okay, so quite a bit. Well, it's easy to, work in that market from California. It's easy flight, it's easy drive if you have to. So I think I saw one of my friends, Tony Villasenor, asked a question. I just popped in about restaurants, and I think one of the questions is just product type. Because, used to Starbucks, or I'll use, Red Lobsters or any single tenant restaurant was pretty highly desirable. And now these days, with all this, are the restaurants all going to be able to survive? Who's paying rent? That sort of thing. Do you see that impacting your cap rates? at all right now? And sort of what product is stronger in your market, just from a who are the tenants and I mean, I know everybody loves Walgreens and CVS and stuff like that and your Albertsons, but as far as some of the smaller deals, you know, are the cap rates getting impacted, you know, by people not paying rent and stuff like that? Or
Yeah, I definitely think cap rates are being affected, especially by the larger sit-down type restaurants where, you know, they do focus a lot of having customers inside. And the restaurants that were buoyant and able to respond to doing a to-go model straight away, or, you know, making sure they're on Uber Eats and other types of delivery methods, if they weren't already doing that, I think they felt the struggle much quicker. The QSR tenants who already have, you know, a drive-through, they already have that to-go component. I think they were able to recover quicker, and therefore that does show in their cap rate kind of holding. And the sit-down restaurants, I mean, their cap rates are increasing. What would you say the basis point change would be?
I mean, I think it's just still out there. You know, we closed a Chili's and a Macaroni Grill deal, kind of two different pads, same shopping center, sold to one buyer. That was a deal that was cut pre-COVID, and due to some mutual delays in closing and refinancing, it kind of got caught up in COVID, almost the time kills all deals type of issue. It got closed. There was a discount from the original asking price, but I don't know that that really reflected what the discount might be in a new current market transaction. So I think sit down's still out there a little bit. Everybody hopes that, you know, that's in that sector, hopes that things can settle down and revenues can return. But I think candidly, until you can get back to 100% occupancy, those businesses really thrive on that top 25%.
yeah.
But I would say too, in terms of cap rate specifically, corporate and who's paying rent and the concern that that might ripple through, it's really a stark difference between corporate and franchise driven. You know, we sold a El Pollo Loco new construction during COVID. We put it on in late March, and inside of 45 days closed at a 4.36 cap. I think it was a new record for El Pollo in this market. And at the same time, the Denny's right next door in a shared pad scenario, we had appraised at a 4.75 pre-COVID when, you know, the development took place, and it's in escrow now at a 5.5. So
Almost a full.
that's still a 50, 60 unit Denny's franchisee, but just big difference we're seeing between even strong franchisees and corporate signatures.
So in addition to that, does the drive-through help? Since everybody wants drive-throughs. I think it's so funny, you know, back not so long ago, all the municipalities were like, oh, drive-throughs are bad, and, you know, you got to have all these queuing lanes, and now everybody that has a drive-through is like, hey, this is really a good thing. And so do you see that making a difference too between like Denny's and El Pollo Loco, just because of that?
Huge, I think. And I think that's a trend to watch going forward. You know, if I'm placing funds for a family office that's buying net leased, you know, I think that drive-through entitlement and that drive-through business is really where I'd want to be if I was forecasting for my, you know, inheritance or what have you.
Yeah. Yeah. So any of those quick service restaurants in that category, you know, McDonald's and Burger King and, you know, all of those, I assume those cap rates will probably stay, you know, fairly consistent just because they have those drive-throughs, and it's, you know, it's easier for them to stay in business, you know, when a lot of this happens. Interesting.
You know, we brought a Starbucks to market yesterday at a you know, brand new construction, trophy location, extremely high traffic counts, you know, growing upper demographic area, Las Vegas. We brought that out at a 4 cap and had tremendous activity in the first day of launch. So it'll be interesting to see where it trades. That's certainly a low water mark for, you know, the current market, but we expect that to trade mid-4s at best, or at worst, so to speak.
Huh? And the rents on that, are they high, low? I mean, is that like a build-to-suit for Starbucks kind of thing?
It is, yeah. Their deals are all build-to-suits out here in the market. And no, I would say the rent that actually got agreed to, given that this was a deal that kind of wrapped up as COVID ensued, was probably 10+% lower than the average new construction deal in 2019.
Okay. All right. So that may be driving that better cap rate there, or lower cap rate, right?
So Adam, Deana, one of the questions someone came in is they've asked how the protests or riots have affected the sales market in Las Vegas. Has it been negative, or has it really been kind of non-issue for you guys?
We didn't have a ton of unrest here.
We did have protests on the Las Vegas Strip. There really wasn't much off the Strip. And in terms of riots, I don't think we had any rioting.
No, and I think even largely speaking, the more disruptive protests were very early on in that process, and really we haven't seen that in months, it feels like.
Yep.
What is going on, it seems like it's been respectful and in areas that don't necessarily impact. I think that's easy to say when our visitor volume's down as big as it is. If it was a normal week in the life of Las Vegas and that stuff was going on, I think it would have a much more pronounced disruption. Unfortunately, the streets are kind of bare down there to begin with. But to Deana's point, I think largely, the demonstrations were focused on tourism areas where they would get exposure, and it really didn't have much of an effect on the retail suburban market.
I guess another question is the QSRs. Who do you see that's a strong, which strong chains do you see are still expanding locations?
Starbucks, Raising Cane's, McDonald's, Dutch Brothers really growing in our market and all over throughout the Southwest. The Burger King franchisees active, El Pollo Loco's been active. Really your drive-through driven concepts for the most part are pretty active. Golden Chick is one that is coming into the market out of Texas. Smoothie King announced an expansion into the market as well over the last 30 days or so. So again, I think the drive-through driven stronger concepts are seeing opportunities right now. You haven't seen, back to the distress that hasn't manifested itself yet, you haven't really seen a ton of drive-through oriented buildings come back on the market or get recaptured by landlords. But I think you've got the more active corporate tenants that are really kind of monitoring all of that and looking to take advantage of second generation opportunities.
And you guys represent some of those tenants in that marketplace, right? Like Starbucks and.
We do, yeah, Starbucks and Raising Cane's. And as an office, we represent In-N-Out Burger, Cafe Rio, Cafe Zupas, a long list of active retailers. Deana and I represent Chili's, Brinker in the marketplace. And Starbucks is very active. Raising Cane's is very active. Travel bans are probably the biggest inhibitor right now of deals in that sector because, pad frontage oriented drive-through stuff is still pretty active. But getting deals across the hump in terms of getting real estate managers in town to drive and tour sites has really been, what's holding up a lot of deals. If we could get Raising Cane's, for instance, in town to drive sites, there's several that are ready to move, but waiting on clearance.
Oh yeah, so that's probably driven by them too, right? Their corporate not allowing them to travel, right?
That's it. Yeah, it's not national travel restrictions, but just these major corporations that are the strength of what's still moving in the marketplace also have corporate policies where they're hesitant to get their teams out there traveling around.
I didn't even think about that. Huh.
So you guys, I think you touched on it that the distress really hasn't come. So I'm taking it that you haven't really seen any real retail evictions yet or anything along those lines. It's still a little early to tell how that's going to look.
Yeah, we were able to start commercial evictions July 1. Obviously, many landlords are trying to make it work with a current tenant that is not behind, who is, not late paying prior to this, and trying to secure those tenants and make it work. So they're working on deferment agreements and things like that. So in terms of evictions, we haven't seen a tremendous amount of that happening. If the tenant was already struggling pre-COVID, then they just move forward with that eviction, just knowing that they weren't healthy prior. And so now would be a good time to try to backfill with a replacement tenant. There's also a lot of active tenants that are out there that are seeking an opportunity, maybe on a second generation restaurant space they wouldn't have the opportunity of having before. So we're getting a lot of phone calls on some of our landlord listings and asking if there's any restaurant space coming available, things like that, that they might be able to take advantage of.
Yeah, I agree with Deana. I mean, you're not seeing much in the way of evictions yet outside of tenants that were already in trouble pre-COVID. You've seen some landlords not want to band-aid a problem that pre-existed. But if you're a good tenant that a landlord wants to keep, you're seeing a lot of, deferment agreements and, rolling months to the back end of the lease type of deal to keep a good tenant in place.
I saw a question come in about the submarkets, but before we answer that, I wanted to just touch a little bit on how's the exchange market? How are the trade buyers? I mean, you guys is that the trade buyers still active there? I know there were some rules and some dates around, maybe that was going to impact that business. What are you guys seeing there with the exchange buyers?
Yeah, Deana, you can speak a little bit more to a couple of the recent offers that we've gotten, but we really looked at July 15th as a day where the exchange-driven transactions were really going to drop off, given the extension deadline. And we've been pleasantly surprised. I mean, we're still getting offers from exchange buyers that are actively identifying. And, I don't know, again, if you had a rush leading up to the deadline and the cushion that provided a lot of buyers, and then you've got a concern out there about 1031 exchanges going away, which I think is driving assets to hit the market for sale and in turn driving exchange transactions. But I think we received an offer yesterday on our Albertsons single tenant from an exchange buyer, and we're negotiating with another exchange buyer now.
Yeah, and we got another one last night, which was a separate exchange buyer. So I think that they're quite active. Like Adam said, we did see a little bit of a blip after the July 15th date. It was kind of quiet for maybe a week or half or so, and then it just picked right back up. People are now engaged again on filling those exchanges. And we're seeing some multi-generational wealth come into the market and seeking assets as well. So
I was going to say the same. I mean, the exchange buyers really are everything from the, guy that has $1 million to $2 million in equity and needs to replace some debt. So he's looking for a $3 million-ish type of deal, all the way up to, several family offices with, upwards of 50 to 100 million in exchange funds that are actively looking for assets in Southern Nevada market in particular. Back to the Southern California move, I think you see a lot of, larger asset sales coming out of that market with large exchange buyers out there.
Are you seeing any issues with those exchange buyers having the ones that have to replace their debt? I mean, are there new loans, assuming loans? I mean, maybe it's a little early to tell in the cycle here, but just curious if you're seeing any trends there.
Yeah, it's a great question. I mean, I would argue that, debt for smaller retail and multi-tenant retail has all but vanished. You can get some term sheets now, but I haven't seen many of them come through to actual loan funding. Most of the debt we are seeing in transactions that we're participating in, largely relationship-based loans. The CMBS world is tough right now. We had a quote the other day that Deana received that talked about the lender taking a 10% discount above whatever your actual vacancy is, and then starting from there. So I just think loan to value in the eyes of the borrower versus loan to value in the eyes of the bank, the gap's widened, further than I've ever seen it. And, at the same time, a month to 2 months ago, you couldn't even get a term sheet on retail. So it's improving in that there's more lenders, leaning into the marketplace and putting term sheets out there and engaging. But no doubt, higher leverage, non-recourse debt is very challenging these days, and in some cases affecting transactions.
So you said 2 months ago it's tough to get a term sheet. Do you think it's almost a given that all the tenants are asking for some sort of rent relief or something in this environment, especially a lot of the big guys, right? They're maybe worse offenders than the little mom and pops. And so is it maybe that everybody's sort of comfortable with that now? It's like, hey, everybody's looking for a little bit of rent relief or tacking on a little bit of term at the end. And so it's not as big of an issue as it was when this all started, perhaps? Is that?
Less uncertainty, for sure. I think a couple months ago, no one knew how long, what's going to happen, when are we going to open back up type of conversations. And I think we're a little bit past that.
Yeah, and I think we've kind of solved all those deferments by this stage for most of the properties. Some of our landlords sent out a blanket deferment agreement saying, here's what we're willing to do for you. Some were just taking it as a case-by-case basis, and some were not willing to negotiate any type of deferment. So I think it really just depends on the tenant. But I think at this stage, at least for our market, most have worked through those deferments at this point.
So it's quantifiable then, right?
It's such a black eye anymore. I think we touched on that the other day catching up. It's, pre-COVID world, any kind of a deferment with a tenant like that would really be a ding on your rent roll. And, it feels like, to Deana's point, having those deferments sorted out, agreed to, documented, and in place, it almost, makes your rent roll a lot more sellable these days.
Yeah. And everybody expects it, I guess, at this point too, right? I mean, yeah. Okay. All right, cool. So the exchange market's still solid, and sounds like, cap rates are holding, and that's good. I think one of the questions I saw come in, Robert, right? They're asking about the submarkets, how's Henderson holding up, and how, where are the stronger submarkets, and how are those looking? I think was one of the questions I saw, Robert. Is that right?
Yep.
Yeah. So obviously we have some people that are curious just how the suburbs are holding up through all this.
I think the suburbs are especially in those quality, Henderson, Summerlin trade areas, are doing really well. I think when your shopping center was closer to the strip and really feeding off the tourism and the convention traffic, those shopping centers are struggling more than the suburban submarket, really overall. So I think Henderson's doing well, Summerlin's doing well. Most of the submarkets, if it's a well-anchored center, are doing well. You'll drive these shopping centers and they're busy. There's a lot of cars in the parking lot, and people are back to work in those types of environments. So.
Yeah, and I would argue that the leasing activity that's coming back is largely in the higher end neighborhoods, Summerlin, Henderson, mid to upper demographic areas. So I'd argue a little bit of a tale of two stories in terms of the lower demographic areas, to Deana's point, more centralized to the strip, that are going to be more prone to the hospitality based on employment. You can see a little bit of struggle in those, and I doubt you've got the leasing activity that you do in Summerlin. Vacancies that are coming up in Summerlin are getting backfilled right away, and there's a lot of interested activity out there right now. And I just think there's, inner city or just tougher demographic areas more prone to the service industry that, are probably telling a little different story.
Yeah, but I think that's one of the things that made this conversation interesting is, right, you have so many different things going on in Las Vegas, right? I mean, the strip is a whole, almost a city in and of itself, right? And then the rest of the market, high end, low end, I mean, you have a little bit of everything there, right? And so I think you give a pretty good cross section of what's going on in the world there. So,
and just when things do turn back on, which they will, there's, pre-COVID and still continuing, just a ton of large scale infrastructure and entertainment projects under construction. You've got the new Raiders Stadium, Allegiant Stadium, almost $2 billion development that just got completed. You've got the convention center expansion that was about $1.4 billion getting completed. You've got Resorts World, which is another mega resort, kind of like City Center, that's continued construction throughout the pandemic and moving towards completion. So, you still have a lot of large scale investment happening in Las Vegas and, hospitality, tourism related development. So that's keeping us going a little bit. If the construction industry shut down, that'd be a big blow on top of tourism. But I think we're building to be ready when this light switch turns back on.
and it will. I mean, it will. I mean, I think we're all anxious for it to get back to how it used to be. But are the Raiders going to play? Do you know? Are they?
No, they sent notices to the personal seat license holders already indicating that they're not going to have fans in the stadium all year. Still haven't heard whether they're going to extend the PSL an additional year. It's a 30-year term. So a little bit of question marks there, but no, at this point, I think they decided if we can't have everybody, we're not going to have anybody. Beautiful stadium. Fun when we can get in there.
So there's a couple questions that have come in, so I'm going to kind of just work through them. First being, there's two related questions. I know you guys focus on retail, but the office as a whole is, can cover it all. Someone was just wondering just briefly how the office space has been affected. And then, also the tag onto that is what space has been most affected, like a gym or, what are you kind of seeing or hearing from yourselves or your colleagues?
Yeah, I mean, we work with Mark and Travis on the office out here in the Southwest. And, they were reporting to one of our clients on a call last week that their activity was really strong and stronger than they anticipated. They had a little skepticism in how many of the current negotiations and escrows that they had going were going to manifest and be real. But I think between the SBA initiatives that are out there for businesses and kind of the pent up demand, they're seeing a lot of activity. Again, I from their own words, caution that to say that, maybe 30 to 60 days will play out how much of that really turns into transactions. Deana, what would your thoughts be on just most impacted spaces in terms of retail?
Of course, the gyms are impacted, but ours are open as long as you're wearing a mask and keeping your distance, you're allowed to work out. I would say the movie theater industry is probably the entertainment. That's probably the most impacted, from Cirque du Soleil shows on the strip to, taking your family to the movie theater. So I think that's probably the entertainment industry, I would say, is probably the most impacted. Nightclubs, things like that, I think are, for our market, the most impacted.
Awesome. What about how's the market for 20,000 to 40,000 square foot retail centers? It's a pretty direct question.
Or Marshalls and Ross and those guys still.
Yeah, I was just going to say, it really depends on your co-tenancy and your mix there, whether that's 40,000 feet comprised of 2 to 3 junior boxes, or whether it's a 20,000 foot box and some shops. We're underwriting an asset now with Hobby Lobby, Barnes and Nobles, and some additional shop space. And I definitely feel like there's some upward movement in the junior box and box type multi-tenant cap rates, outside of grocery anchored and real core assets. So those spaces are going to be challenging.
I know this isn't necessarily where you guys focus, but we talked about it the other day a little bit. The industrial market in Las Vegas has remained very strong, right? With distribution and people leaving California, and it's a short jaunt to the port in Los Angeles from there. How's that market looking? Just, summary wise.
Yeah, it's growing quite a bit. I think one of the questions that a lot of people were concerned with is Las Vegas diversifying outside of gaming and the strip? And our response to that is the industrial market here, specifically distribution, has really increased quite a bit. Focusing on 200,000 square foot buildings, now up to 1 million plus square feet. We've just seen a surplus of that coming to market and becoming leased straight away.
Yeah, it was a white hot market in 2018, 2019. And from everything that we've heard, it's really, activity remains very strong. The developments that are underway certainly haven't stopped. It was an interesting dynamic for industrial in Las Vegas. Historically speaking, the strongest industrial submarkets, highest rents, lowest vacancy was always the industrial that bordered the strip and the airport corridor. And for the first time in our market, that was really the tough spot, where the newer growth in industrial was really focused out in North Las Vegas and areas of West Henderson, focused on the I-15, and to Deana's point, large 1 million plus square foot distribution buildings with, Fortune 100, retailers occupying them. Those submarkets fared significantly better in the early parts of the pandemic and business closures than did the ones that were, focused on servicing trade shows and strip properties and things like that. But without a doubt, I think some of the biggest diversification and industry growth in Vegas post-recession has been just the emergence of real large-scale distribution. We're trying to get more diverse in the medical arena and working through the university system on things like that. But industrial has been a big part of the growth.
Well, down by the airport and around the strip, I think it's size constrained, right? There aren't any 500,000 square foot buildings and stuff down there, or very few, right?
30 acres sitting there ready for development.
Right. Yeah. Huh. So what's the strongest submarket then right now, in your mind?
I'd argue Summerlin.
Summerlin?
Areas of Henderson that rival that in terms of demographic and retail, makeup. But I'd argue from a residential standpoint, from a retail standpoint, from an office standpoint, Summerlin's really been the darling post-recession.
Yeah, specifically the southwest of Summerlin, I would say like Summerlin South. Summerlin is a large span of the west side of the valley, but I would really say the most desirable and highest growth would be the south portion of that.
Correct.
Specifically.
Well, it sounds to me like the overall market there is pretty strong, and it's stayed, other than the gaming and some of the hospitality stuff, it sounds to me like cap rates are holding. You still have a lot of activity. You're getting offers. You're closing transactions. Retail tenants are still, making some deals out there. So it sounds overall like the it's looking pretty solid.
Yeah. Knock on wood, we've fared well, thus far. And, again, I would say that there's been a lot of stimulus in the marketplace, not just in Las Vegas, but nationally, that I think has staved off some of the pain that'll have to naturally occur with what we've experienced. But in general, our suburbs have held together. We're limping along in hospitality, but to your point, I think the other positives of our business environment and our local economy have really held together fairly well.
What it sounds like.
Yeah, I think Las Vegas is just a resilient market overall. I mean, even from the last downturn, kind of came back bigger, stronger, and I think this time around will be no different. So I think we're in a much better position than we were when the last recession occurred, and I think we'll be even more resilient this time around as well.
Yeah, I think we were in a really good spot leading into this. In terms of like when you get sick, you want to be healthy and in shape and strong going into it, so you have the best chance of survival. And I think the Vegas economy, the growth, the engines driving that growth, were really deep, and that's manifesting itself, I think, in just specifically how well some of the stronger suburbs are doing. I think the amount of savings and disposable income that was there leading into this. Certainly there's tough spots in our valley, and you just can't avoid that when you've got peak unemployment at 33%. Statewide we're down to about 15% now, but I'd argue that's weighted more into the 20 for Southern Nevada and 10 in Northern Nevada. So directly here in Southern Nevada, we can't overshadow or ignore the fact that there is a lot of unemployment. There is struggles to get back until daytime business returns to the strip, not daytime, but weekday business returns to the strip. So not out of the woods, but, large in part, there's still opportunities. The better parts of the market are holding steady, and we'll see what happens.
Well, I think that market's changed a lot in the last 10 years, right? I mean, it used to just be all about the gaming. And again, we're talking about the industrial markets growing, and, you're bringing in big corporate users, which create jobs and stuff like that beyond the strip. I think, I think Las Vegas is a different place than it was 10 years ago. It's so much more diverse. I think, I just saw one question there is like, are there certain parts of the market there to avoid if you're an investor? Certain suburbs or certain submarkets that just are not going the right direction? I think that was a question I just saw.
Yeah, I mean, I think it depends on the risk tolerance of the particular investor and how hands-on or lack thereof they want to be. You know, I definitely think that there's easier areas to purchase and maintain value in, but those values have held pretty high, pretty strong.
Yep.
So, you know, I think the discount for challenging areas is commensurate with that risk here in Las Vegas, and kind of always has been. You know, there's a premium both in cap rate and price per foot to be in the upper neighborhoods. And there's also opportunity in cap rate and price per foot, you know, when you're looking at more challenging areas. But really, you've got to be willing to roll your sleeves up and hire the right local teams and be willing to backfill spaces as they come up and deal with, you know, local regional mom pop type credit, you know, and there's certain investors that thrive in that and, you know, don't mind getting their hands dirty and eke out higher yields. And, you know, you've got the flip side of that coin that would rather, you know, pay for quality and, you know, put it on the shelf.
So that answers a good overall question too. Sounds like you have a little bit of everything in Las Vegas, right? You got people that are a little more taking risks. There's spots for them, risk averse, you know, the 1031 market's staying strong. So, I mean, just maybe a few closing thoughts on you know, what you think the future looks like there for you guys and your business and Las Vegas in general, as you guys have both been there a really long time and, you know, have pretty deep roots there. And I think you're also both involved in, you know, some political and corporate and civic organizations and stuff in town. So you probably have a pretty good pulse on what that looks like over the next 5 years.
Yeah, we've both been here since the 90s. And so we do have a really strong connection with Las Vegas, and just kind of mirror what we said earlier. I think the market will be resilient. I think, you know, it's going to have a positive kind of outcome and kind of continue in the right direction. I think for the next 5 years, I think most investors will take a double look at this market and want to come and invest in Las Vegas from Southern California, or anyone who's searching for a tax-friendly state like Nevada.
Yeah, and we believe that there's just a tremendous amount of pent-up demand for domestic travel. And, you know, no one was happy that ICSC got canceled last year. So or this year, that is. So, you know, we need the confidence to return nationally, to, you know, gather in groups and to travel. And hopefully we're leading in that direction in terms of, you know, whether it be vaccine or immunity. But, you know, I think that's the key indicator for Las Vegas. When you're comfortable hopping on a plane and flying here for a business meeting, and those around you are as well, that's the light switch for Las Vegas that's really going to pull us out of, you know, unemployment and tales of two stories. And, you know, we're a resilient and optimistic bunch out here. So I feel, you know, we'll continue to, you know, you got great minds on the Strip doing everything they can to create safe environments and, you know, promote travel. And, you know, I think that once everything can calm down a little bit, the bounce back will be pretty stark.
Well, we're all looking forward to coming back over. Just saying, you know, we all missed ICSC.
It can't be soon enough.
It can't be soon enough.
One last question came in, and Tony came back and asked, how has Crexi helped you in your business?
We love Crexi.
Well, Crexi, I guess.
Yeah, when we first heard about Crexi, what I really enjoyed about the platform was being able to contact principals and talk with principals and kind of know the distinction between the two. You know, I think the sales platform, very clean, very easy to use, easy to see the metrics behind who's seeing your listing. So we were happy to sign up for the pro version. And then I also like that they're now doing the leasing side of it. I think that's important to have both to understand. Obviously, lease rates help with your investment sales. You kind of need to do both. So I think it's great, the direction that Crexi's going. It's nice to have competition amongst the other platforms.
Yeah, I agree with Deana. I think the reach to principals has been impressive, and, you know, unique principals in a lot of cases. You know, I feel like sometimes with other platforms, you kind of see the same batch of buyers every time you put an asset out there, and I've just been impressed with kind of the unique principal buyer leads.
Oh, that's good to hear, because we view you guys as our partners, right? As we move along down the path here. So it's nice to hear that, we're bringing, the right group to your assets. That's good to hear. And thanks, Tony. I haven't seen Tony's a good friend of ours. We've known Tony for a long time. So anyway, I think, we're sort of butting up against the hour here, and this has been really enjoyable. I've really enjoyed hanging out with you guys for a while. And I think you had some great insight there into the market, and we really appreciate you guys participating in this. Hopefully you had fun. I think Robert and I did. So
Yeah.
Yeah, thanks for making it conversational. That was a nice format, and we appreciate the opportunity to come on.
Thank you.
And as soon as Vegas is back on, we're coming out there and we're all going to dinner. Okay.
Ready.
No, without calling us.
All right, you guys. Thanks, everybody. And thanks, everybody that joined out there in the virtual world, too. So appreciate everybody's participation.
All right, guys. Have a great day.
Guys.